Welcome to the Byte-Size Brief. Today we are putting Meta Platforms DRC META, that's META, completely under the microscope. Let's get into it.
I am really looking forward to this one. It's a fascinating situation.
It really is because, we have the central paradox to untangle for you listeners today. I mean, how does a company across $200 billion in annual revenue absolutely crush Wall Street's expectations and then still watch its stock drop like 17% in a matter of months?
Right. It seems entirely counterintuitive on the surface.
Exactly. You are looking at a business that just reported its best year in history in 2025, yet sitting here today in early April 2026, the market is just aggressively selling off the shares.
Yeah, aggressively is the right word.
So our mission for this deep dive is to uncover whether this massive valuation asymmetry is, a rare opportunity to buy into a dominant tech giant at a discount, or if that 17% drop is actually a warning sign of deeper fundamental cracks.
And it really is the ultimate push and pull scenario for the market right now. But to ground our analysis, we really have to start with the objective reality of their recent Q4 2025 earnings blowout.
Right. Let's look at those numbers because they were huge.
They were nothing short of staggering, honestly. Top-line revenue hit $59.9 billion just for the quarter alone.
Wow. Just one quarter.
Just one quarter, which represents a 21% increase year over year. And earnings per share came in at an incredible $8.88. They're operating with margins hovering right around 41%.
That's just wild.
It is. When an enterprise operating at this massive scale is generating that level of pure profit, a sustained 17% haircut to the equity value, I mean, it demands that we look far beyond the headline numbers and examine the underlying machinery of the business.
Yeah, because the scale of that is almost hard to comprehend for a regular investor. I mean, generating nearly $60 billion in a single quarter while still accelerating top-line growth at over 20%, that completely defies the traditional law of large numbers.
It really does.
Usually when a company gets this big, growth just tapers off into the single digits. So, where's this massive influx of cash actually coming from right now?
Well, it is entirely driven by a fundamental mechanical shift in their advertising architecture. META has essentially completed its transition from a traditional social media platform into a predictive AI advertising engine.
Okay, break that down for us.
Sure. So if you look back just a couple of years to 2024, digital advertising was heavily reliant on creative matching. Advertisers would produce a visually engaging video, push it out to a broad demographic, and basically rely on users manually interacting with it to find a buyer.
Right, the old scroll and click model.
Exactly. But today, in 2026, their new generative AI systems, specifically their GEM and Lattice models, have completely inverted that dynamic. They've moved to a system of what they call context as targeting.
Context as targeting. So how does that actually work in practice? Like, if I'm scrolling through my feed right now, what is this Lattice model doing differently than the old system?
So the Lattice model acts as this unified predictive layer across their entire ecosystem. Instead of treating your Instagram activity, your Facebook network, and your Threads interactions as entirely separate data silos, Lattice synthesizes all of it in real time.
Oh, wow.
Yeah, it doesn't just look at a page you liked 3 years ago. It analyzes the specific pacing of how you swipe past certain videos today, combines that with the contextual tone of a text post you just read on Threads, and predicts your immediate purchasing intent.
That's slightly terrifying, but also amazing.
It is. It anticipates what you are likely to buy before you've even consciously made the decision to search for it.
Okay, so basically it's like having a hyper-intelligent salesperson working for the advertiser. But instead of standing in a department store shouting at everyone who walks by, hoping someone needs a winter coat, this salesperson already knows you are planning a ski trip, knows your exact size, and walks right up to hand you the perfect jacket just as you realize you are cold.
That is the perfect analogy. And that precise targeting mechanism is exactly what is driving the financials. Because the prediction is so accurate, advertisers are seeing an exceptional return on investment.
And they're willing to pay up for it.
Exactly. The data from Q4 proves this out mathematically. The total volume of ad impressions grew by 14%, and simultaneously, the average price per ad jumped by 10%.
Wait, volume went up and price went up at the same time?
Yes, which is huge. In the advertising industry, increasing your inventory volume usually forces you to lower your prices due to oversupply. The fact that META can increase the number of ads shown while charging a 10% premium for each one, I mean, it indicates that advertisers are completely dependent on this AI to drive their own sales.
Yeah, they have no other choice.
Right. Now, when you look at the broader digital landscape, you see competitors like TikTok completely overhauling their backend to match this engagement, and Google's ad systems are attempting to pivot towards similar generative AI models to preserve their search dominance.
Right, but what does all that actually mean for META investors? Because we hear about TikTok and Google's AI ambitions literally all the time, but keeping the lens entirely on our subject today. How does this specific technology protect META from that exact competition?
It comes down to the sheer volume of their proprietary data. META has 3.5 billion daily active users.
Billion, with a B.
With a B. No matter how sophisticated a competitor's algorithm might be, AI models require vast, continuous streams of human behavioral data to learn and predict accurately.
So it's a numbers game.
Entirely. By feeding the daily interactions of nearly half the global population into the Lattice framework, their predictive engine achieves a level of accuracy that is virtually impossible for a competitor to replicate from scratch. The data scale itself is the moat.
That makes total sense. Okay, so compared to last quarter, what actually moved the needle here? Because when we look at how that predictive power played out in the immediate short term, the sequential growth is where things get really stark. Q3 was strong, but Q4 was an absolute monster.
Yeah, the quarter-over-quarter acceleration perfectly illustrates the compounding effect of these AI optimizations. In Q3 of 2025, revenue sat at $51.2 billion, yielding a very healthy free cash flow of $10.6 billion.
Which is already massive.
Right, but just 3 months later, in Q4, revenue surged by nearly $9 billion to reach $59.9 billion, and free cash flow jumped to $14.1 billion.
That's incredible.
And that sequential leap wasn't just seasonal holiday spending. It was driven by algorithmic tweaks that radically increased user engagement. The AI is not just better at selling ads, it is fundamentally better at keeping users on the platform.
So the system is optimizing both sides of the equation simultaneously. It's keeping you glued to the screen longer, which creates more ad inventory, and then it's filling that inventory with higher-priced, hyper-targeted ads.
Exactly the case. And we can see this directly in the engagement metrics. From Q3 to Q4, the volume of reels that the system surfaced to users, meaning content recommended by the AI rather than accounts the user explicitly follows, jumped by 25%.
The 25% jump in one quarter.
Yes. They successfully reduced the latency in their recommendation engine, creating this seamless, highly addictive short-form video experience. Furthermore, their recent optimization of the Threads algorithm drove a massive 20% lift in time spent on that platform in just 3 months.
Which is a massive structural advantage for retail investors looking at the long-term horizon. I mean, Threads has scaled to roughly 400 million users now, and they haven't even flipped the switch on fully monetizing it yet.
Not at all.
It's essentially an unexploited digital real estate asset. If they take this highly refined, hyper-profitable Lattice ad engine and apply it to a text-based platform where people are already spending 20% more time, I mean, that represents billions of dollars in purely incremental future revenue.
Absolutely. Analysts are currently projecting that Threads could represent a $6 billion to $8 billion annual revenue opportunity once it reaches maturity.
Wow.
So you have a core family of apps throwing off over $14 billion in free cash flow in a single quarter, paired with entirely untouched monetization levers still waiting in reserve.
But, you know, that immense cash generation is exactly what makes the current stock performance so perplexing. If they are printing this much money and engagement is up across the board, why is the stock down 17% this year? Where is all this cash going that has Wall Street so heavily on edge?
Well, this brings us to the core of the bear thesis, and it centers entirely on their 2026 capital expenditure guidance.
The dreaded capex.
Exactly. META is currently guiding for an astronomical $115 billion to $135 billion in capex for the 2026 fiscal year.
Wait, $135 billion?
Up to $135 billion, yes. To contextualize that number, it represents roughly a 75% increase from their already massive 2025 spending levels.
That is just, wow.
A significant portion of this is going toward a newly signed $27 billion AI infrastructure deal with the cloud provider Nebius, alongside the construction of a $10 billion 1-gigawatt data center located in El Paso.
Hold on, how does that actually affect META's stock price for regular investors like me? Allocating $135 billion in a single year to servers and physical infrastructure sounds like an unprecedented amount of capital. Are they just lighting our cash on fire to win an AI arms race?
The mechanism driving the stock price down right now is a financial concept called free cash flow compression.
Okay, explain that.
When a company increases its capital expenditures by 75% overnight, Every single dollar of that increase comes directly out of the free cash flow that would otherwise be returned to shareholders through, say, dividends or stock buybacks.
Ah, so the investors feel the pinch immediately.
Precisely. Institutional investors are looking at this massive outlay and worrying about the return on invested capital. META is building out hundreds of thousands of next-generation GPUs and securing gigawatts of power without a guaranteed immediate line of sight to how that specific hardware will generate a proportional profit in the near term.
You know, it feels very reminiscent of how the market treated Amazon a decade ago. Between like 2013 and 2015, Wall Street aggressively sold off Amazon because Jeff Bezos was pouring literally every cent of profit into building a massive physical logistics network.
That is a highly relevant parallel.
The market wanted immediate margins, and Bezos was building warehouses.
Right. And during that Amazon build-out, free cash flow evaporated and the stock struggled. However, once that physical infrastructure was operational, it created a logistical moat that effectively ended the competition's ability to compete on shipping speeds.
And we all know how that turned out for Amazon stock.
Exactly.
Yeah.
META is executing the exact same playbook, but replacing physical fulfillment centers with raw compute power. This $135 billion is securing the physical architecture required to train and deploy their upcoming Llama 4 models, specifically the Scout and Maverick versions.
Okay, but explain the strategy behind that for a second, because Llama is open source, right?
Yes, it is.
They are spending hundreds of billions to build the world's most powerful AI, only to give the underlying architecture away to developers for free. How does that translate to value for the shareholders?
By open sourcing models like Scout, which is optimized for edge devices, and Maverick, which handles massive server-side reasoning, they are establishing an ecosystem lock-in.
How so?
When thousands of developers and enterprise companies build their internal tools, applications, and workflows on the Llama architecture, it becomes the default industry standard. It forces hardware manufacturers to optimize their chips specifically for META's ecosystem.
Oh, I see.
Yeah, once you control the foundational layer of the entire industry, you dictate the future protocols and integration pathways, which is a position of immense strategic power.
And this ties directly into their recent acquisition of Moltbook, right? Because when we talk about what all this compute power is actually going to do, it's not just about serving better ads to humans anymore.
No, not at all. The Moltbook acquisition signals a highly ambitious shift in their long-term vision. Moltbook is fundamentally an AI social network built around autonomous agents.
An agentic network.
Exactly. We are moving from a paradigm of a human social graph to an agentic network. In this environment, AI assistants, basically bots, are interacting with each other on behalf of users. You can envision a scenario where your personal AI agent negotiates a purchase with a retailer's AI agent, books appointments, or curates information entirely autonomously.
Which, I mean, requires an entirely different magnitude of computing power. A human being can only scroll through a feed for a few hours a day. There are physical limits to our attention. But an agentic network operates 247, processing millions of autonomous microtransactions constantly.
Right, the scale is astronomical.
So to facilitate a global network of billions of AI agents talking to each other, you absolutely need a 1 gigawatt data center in El Paso. The infrastructure isn't just for today's social media, it's the foundational plumbing for an automated internet economy.
Which brings us back to the valuation asymmetry we started with. As an investor, you are paying for the massive profits of today's ad business, while subsidizing the highly expensive plumbing for tomorrow's agentic economy.
That makes a lot of sense when you put it that way.
But it is vital to understand that infrastructure spending is a calculated, strategic choice by management. However, there are two other massive headwinds weighing on the stock that are far less constructive.
Okay, let's get into the bad news.
The first is the ongoing situation with Reality Labs, their virtual reality division. As of early 2026, Reality Labs has accumulated a cumulative operating loss of $83.6 billion.
Ouch. An $83 billion hole in the balance sheet is just staggering. But we did see them initiate layoffs in March 2026, right? Cutting roughly 700 people, with a significant portion of those reductions hitting the Reality Labs division. Is the market interpreting this as management finally showing some capital discipline? Are they quietly winding down the hardware ambitions?
It is definitely being interpreted as a necessary strategic retreat. The pivot is clear. They are shifting organizational priority away from consumer hardware-led virtual reality and redirecting those resources into the core AI infrastructure we just discussed.
Which Wall Street usually likes.
The market does appreciate the cost-cutting, yes. But the sheer scale of the historical losses in that division continues to act as an overhang on their valuation multiple. However, the operational drain of Reality Labs really pales in comparison to the second major risk, which is entirely external and highly unpredictable.
Right. This is the little headwind. And to set the stage for you listening, whenever we delve into judicial decisions on this show, we're looking purely at the mechanics of the verdict, the legal precedents established, and how institutional capital is modeling the financial risk. We are examining the ripples, not the underlying politics of the case.
Exactly. So objectively speaking, in March 2026, a landmark jury verdict was handed down regarding youth addiction on social media platforms. The jury found META 70% liable for causing harm to younger users. And the financial penalty attached to this specific ruling was a $3 million punitive damage charge.
Now, from a strictly mathematical standpoint, a $3 million fine for a company that generates $14 billion in free cash flow in 3 months is effectively zero. It is a fraction of a rounding error. Yet the stock took a noticeable hit on this news. Why is the market pricing a tiny $3 million fine as a systemic risk?
The severe market reaction is due to the specific legal terminology utilized in the verdict. The jury cited conduct characterized as malice, oppression, or fraud.
Ah, those are heavy words in a courtroom.
Very heavy. This phrasing is the catalyst for what legal analysts are calling a tobacco moment for the tech industry. In civil litigation, a finding of negligence carries a certain level of manageable risk, but a formal judicial affirmation of malice that radically alters the legal landscape.
It opens the floodgates.
It opens the door to punitive damages and establishes a framework for aggressive, highly invasive discovery phases in future litigation across multiple jurisdictions.
So the $3 million is completely irrelevant. It is the precedent that terrifies Wall Street. It's the fear that plaintiff attorneys across the country now have a roadmap to file multi-decade class action lawsuits, utilizing the exact same arguments and discovery techniques that ultimately forced massive settlements from the tobacco industry in the late 1990s.
Precisely. And beyond the direct financial cost of defending endless litigation, there is the existential threat of regulatory intervention.
Which could hurt the core business model.
Right. If this legal precedent leads to state or federal mandates, forcing META to fundamentally alter how their recommendation algorithms function, for instance, requiring chronological feeds for certain demographics instead of predictive engagement models that directly degrades the efficacy of the Lattice model.
Wow, yeah. If the algorithm becomes less engaging, the ad impressions drop, the premium pricing power vanishes, and that core cash flow engine we talked about earlier is totally compromised.
Yeah, exactly. When you lay out all of these variables, it paints a fascinating picture of a corporate duality.
It really does. On one side of the ledger, you have a virtually flawless, hyper-profitable core advertising business that is leveraging generative AI to print an unprecedented amount of cash.
And on the other side, you have a highly uncertain future weighed down by $135 billion in raw compute costs, a historically expensive hardware division trying to pivot, and the looming shadow of a multi-decade legal battle targeting their foundational algorithm. Ultimately, the market is demanding that investors make a choice about management's foresight. You have to weigh the tangible, real-time success of their 20% revenue growth against the theoretical, long-term risks of free cash flow compression and regulatory overhaul.
It's a massive gamble.
It is. META is asking the public markets to trust them as they navigate one of the most expensive and aggressive technological transitions in the history of corporate finance. If the Moltbook acquisition and the Llama 4 investments yield the agentic economy they anticipate, this capex cycle will be viewed in hindsight as a brilliant strategic maneuver.
But if they miss?
If the monetization of those agents fail to materialize, the pressure from institutional shareholders will become immense.
And that is exactly where we turn the analysis over to you. We've mapped out the cash flows, the algorithmic shifts, the massive infrastructure bets, and the legal precedents. So what is your thesis on the future of META? Are you looking at this 17% dip as a rare valuation asymmetry, knowing their AI ad engine is an unstoppable force? Or are you bearish, seeing the $135 billion capex bill and the legal tobacco moment as fundamental cracks in the foundation? Let us know your perspective in the comments.
It's definitely going to be a lively debate in the comments section today.
Oh, for sure. But before we sign off, I want to leave you with a final thought that bridges the two halves of our discussion today. We spent a lot of time breaking down how the Lattice AI and the agentic networks on Moltbook are becoming smart enough to autonomously negotiate purchases on our behalf.
Right.
If we are entering an era where AI agents can accurately predict our desires and execute financial transactions, how long until those same autonomous systems are deployed to negotiate our legal disputes or dynamically curate our political realities based on real-time predictive models? If the architecture can sell you a jacket before you even know you are cold, what else is it preparing to sell you? Something to think about. See you next time on the Bite-Size Brief.